Let's get back to our guest then. Bob Enck, President and CEO of Equinox Fund Management, $5 billion in assets under management, and our guest host, Phil Blumberg, here at the SGX studios. Phil, and just during the break, you were chomping in the bit. You wanted to get Bob a question.
Yes, I did, because I know Bob's exposed across the board. I wonder what he thought of the healthcare sector, both in the U.S. with the pending bill and abroad.
Well, the only certainty I can see in the healthcare world is uncertainty. And what I mean by that is the United States here has passed a healthcare regulation bill, and it's yet unfunded. So you're going to see a lot of uncertainty in healthcare here, which kind of paves the way to say, look, an allocation to healthcare can make sense, but it's got to be coupled with other asset classes that are not correlated at all to healthcare. So, these include the ability to go short as well as long as a number of sectors, whether it's agricultural products, metals, energy, and so on.
Bob, I want to come back to the broader market sentiment. There seemed to be a feeling around the street, it wasn't just yuan related, that potentially there could be some fears about further slowdown in the US economy. There was one key index that many people were watching, which is really correctly called the recession, the pickup in the economy, and it's now suggesting that there might be a period of slowdown. How are you feeling about the extent of recovery?
I think you're right on the money with that. I think the early news in the morning about the yuan was settled quickly, in that there's a lot of concern in the United States about what's going on. So if you look at what other factors are at play here, unemployment here is approximately 10% still. You're seeing taxes. The Bush tax cuts are ready to come off at the end of this year, so taxes will go up. On top of that, you see a lot of state governments here are trying to get their financial house in order, meaning they're cutting employees, they're cutting staff, state workers, and they're raising taxes. So you see a lot of conflicting measures that are really offsetting any of the kind of potentially good news that you may have seen in the morning in the United States markets.
It doesn't really paint a strong picture for the trade you're talking about, Phil. So perhaps you can talk through those factors. Don't they provide headwinds to commercial real estate?
In the commercial real estate sector, there are headwinds with regard to performance of the sector. But the sector's down. We're at 18%, 15% vacancy. That's nothing like it has been in prior cycles where it's 40%. I think the real issue is the softness in the real estate market is far outweighed by the discounts. And the discounts are because of total capital flow shutdown. There is no debt available for real estate, and there's very little equity. And that's brought a precipitous downturn in pricing.
Pricing that makes sense to you.
Exactly. It's pricing. When you can buy at 70% discount.
It's interesting looking at your notes. In fact, you said we're entering an optimal buying period. Yeah. That's why you set up this particular fund. I mean, it's a huge market, of course. So what specifically are you looking at?
Well, our focus is clearly large major markets in the U.S., office buildings centrally located, with a strong tenant profile. You can still buy those now at a discount well below what the replacement cost is. I think as we see commodity inflation, I think Bob's alluding to it, I think we're going to see a significant increase in values, easily 20% a year, as we look forward to an inflationary market. Okay, and I think you've got to be in inflation hedges.
Phil, that's better than the average you've been doing, which is about 17% a year.
Yes. Our average at 17% reflects a 16-year track record, which was primarily a low inflation market. We've had, for the last 16 years, about the lowest inflation. So I think what we're looking at when we talk about 20% going forward the next 8 years is a 2 to 3% premium for inflation. I think that's probably an understatement.
All right, 20% returns, Bob, from managed futures. Can we get that?
The kind of returns you're going to get from managed futures, depending on how you play them, would typically be in mid-teens. That's kind of what they strive for in terms of a broad portfolio of CTA programs. And there's a lot of options to get that. You have mutual funds now here in the United States where you can get a basket of CTA programs available in a mutual fund setting. We happen to have one that we think is excellently run called Mutual Hedge Frontier Legends Fund. And you can see those types of returns. And more importantly, though, you're going to see those returns typically with lower volatility. Now, nothing's guaranteed, of course. There's risk with everything. But managed futures really do provide you an opportunity to pick up when the other markets, whether it's real estate and or equities, are not advancing the way you'd like.
Yeah, it's sounding a little sexier than the single-digit cash returns at the moment. Thanks for joining us, Bob Enck, President and CEO of Equinox Fund Management.